The Spin-off Podcast Network.
Want to shop Walmart Black Friday deals first? Walmart Plus members get early access to our hottest deals. Join now and get 50% off a 1-year annual membership. Shop Black Friday deals first with Walmart Plus. See terms at walmartplus.com.
Ryan Reynolds here for, I guess, my 100th Mint commercial. No, don't. I mean, honestly, when I started this, I thought I only have to do like 4 of these. I mean, it's unlimited premium wireless for $15 a month. How are there still people paying 2 or 3 times that much? I'm sorry, I shouldn't be victim blaming here. Give it a try at mintmobile.com/save. Whenever you're ready.
$45 upfront payment equivalent to $15 per month. New customers on first 3-month plan only. Taxes and fees extra. Speed slower above 40 gigabytes. See details.
When the Facts Change is brought to you by the Spin-off Podcast Network in partnership with Kiwibank, the bank for Kiwi looking to get ahead in business and in life. A bank that delivers expertise in banking know-how, smart advice for business owners wanting to invest, grow their business or diversify. A bank that adapts with technology through the lens of its people and customers. It is a bank with heart that is driven by its purpose. Kiwi making Kiwi better off. A few years ago, Adrian Orr came out and told everyone on the verge of Christmas to cool their jets, to not spend for Christmas. That was then, and this is now. He's just cut the official cash rate by another 50 basis points. And that means there's been 125 basis points, 1.25 percentage points of cuts in the official cash rate since the middle of the year. He's turned from the Grinch into Father Christmas. Whether or not the economy perks up again depends on how we feel about all of this, whether we believe that things are going to get better. Our business and consumer confidence surveys say that we think things will get better, but actually when you look at the numbers of what's actually happening right now, it's still fairly bleak. We are seeing a rise in unemployment, we're seeing a contraction in output in manufacturing and in services, and there really was a need to cut interest rates. This week on When the Facts Change, we talk with Kiwibank's chief economist, Jarrod Kerr, about that 125 basis points of cuts and Jarrod's view that there'll be another 50 basis points in February when the Reserve Bank comes back from its holiday. We talk about Jarrod's argument that there should have been interest rate cuts earlier, that the Reserve Bank probably kept interest rates too high for too long, and he talks about the uncertainties we face in the next year or two as we return to Donald Trump as the US president. We look at the prospect of tariffs. We look at how the longer-term effects of climate change, aging populations might affect inflation and interest rates. And we have a bit of a chat about, whether we really believe interest rates will drop quite sharply early next year, and therefore what might that mean if we were thinking about fixing or floating, if we were lucky enough to, or unlucky enough to have a mortgage and own some sort of home. That's this week on When the Facts Change. The Grinch turns into Father Christmas. Well, kia ora, and welcome to Jarrod Kerr, the chief economist for Kiwibank, here on the afternoon of the Reserve Bank's 50 basis point cut. Jarrod, what did you think of today's decision?
Oh, kia ora, Bernard. Look, we got what we wanted. We wanted a 50. They gave us a 50. Rates are still falling. There's more to come. And I think, we need to look at this through the lens of, businesses and households. This is good news, and we can look to next year with a bit more optimism.
Yeah, we've already seen interest rates fall a bit. This will be another confirmation for any of those banks just holding back a bit. But next year, we got the message from the governor that it's quite possible there could be another 50 basis point cut when the Reserve Bank gets back from Christmas in February. What might that do to interest rates, mortgage rates, the economy through next year?
Well, I mean, we will be advocating for another 50 in February. In my mind, I want that cash rate below 4%, as soon as we can. We've been at 5.5%. That was incredibly restrictive. we're at 4.25 now. That's still restrictive. Get it below 4, and then we can start talking about 25 basis point moves back to neutral, wherever that is. I do think there is a need for a bit more urgency still as we go into next year. What does that mean for everyone? Well, it means for lower interest rates, lower interest expense, and it means that one of the many things that businesses and households are having to deal with is getting easier.
Yeah, the Reserve Bank seemed to think that there would be some economic growth in the December quarter, and then going through into next year, a recovery, but they were quite cautious about saying, it's a sure thing and it's going to be a strong bounce back. They were saying there was still some uncertainty about it. How did that look to you?
Oh, look, I think there's still a very high degree of uncertainty. We live in uncertain times, and we've got uncertain powers to be, right, coming back into power, which will be interesting. Trump coming back into the United States could cause some issues to global trade, and the global outlook is just highly uncertain how that translates down here. We've seen a lift in business confidence, which is great. We will see a lift in household confidence, which is great. We haven't seen a lift in activity yet, and that's what we need to see. We need to see confidence feeding into activity, which will then help profitability within the economy, and then investment intentions and hiring intentions. That's what we're really looking for. That's when you get real growth, and that's when you sort of bang the table going, okay, we're doing well. Unfortunately, I still think that's at least 6 to 12 months away.
Yeah. Could you argue that the Reserve Bank held monetary policy too tight for too long? Because when you compare our economy with economies overseas, we're bumping along the bottom, barely out of recession, in recession, depending on which measure you use, whereas other economies, they're still growing. And I wonder if because we've now had 125 basis points of cuts in 4 or 5 months, we haven't seen that in too many other places. Did the Reserve Bank hold interest rates too high for too long?
Yes. Short answer, yes, and I think that's my answer too, Bernard. I've been rather vocal on that. I think the Reserve Bank went too high and held for too long. I mean, we saw through our data here at Kiwibank, we saw the economy turn quite quickly at the end of 2022. It's been a 2-year recession, and yes, they've managed to suck some of the inflation out of the economy, but at expense, right? At some inflicted pain along the way. Whereas you look at the RBA in Australia, it's certainly not apples with apples, but their central bank was a lot more relaxed about the inflation trajectory. We'll get back there without having to slam the economy into the floor. They didn't hike anywhere near as aggressively as the RBNZ. And I think looking back, we would probably wish we had an RBA response function.
Yeah, why do you think the Reserve Bank might have gone a bit hard for too long? Do you think there was an overreaction, a sort of a recency bias that meant that they thought we've really got to get on top of this and we'll use an extra big hammer this time?
Oh, I think they were, justifiably concerned with the inflation outlook, and fair enough. We saw a spike in inflation up to 7.3. We hadn't seen that sort of rate of inflation in a very long time. They weren't sure whether they could get it down as fast as it came down. There was a lot of uncertainty, so they took the path of being the most fierce inflation fighter in the world. We were the first to target inflation. We're going to smash it down to 2% hard and fast, whereas the others were just a little more relaxed. Just let it come undone.
Well, there's two sides of economic policy on the table. There's monetary policy, what the Reserve Bank does with interest rates, and then on the other side you've got fiscal policy. And you could argue that both the Reserve Bank and the government of the day in 2020 maybe stimulated too much who knows? There was a lot going on with COVID. But this time around, we've had an economy in recession of sorts through 2022 and 2023. And this government is avowedly tightening policy, whereas in Australia, the United States, other parts of the world, governments are not tightening policy going into a recession. Is there a risk here that the government is effectively, pushing back in the other direction against the Reserve Bank with a sort of pro-cyclical tightening?
Yeah, it's a good point. And it's a fair point, right? I mean, you can see it most notably in Wellington, right? The fact that Wellington, when you look at confidence and these sorts of things, just quite miserable, really, compared to other parts of the country. And I think that the change in government focus to a laser focus on costs is really showing up in the capital, right? It really is. And that's certainly helping the inflation story, but it's not helping the recovery at all. So, you compare that to, say, what we're expecting Trump to start delivering, which is actually quite expansionary. And you see the US economy didn't go through a recession, and, the outlook for the US economy is actually stronger with a bit more inflation than our outlook because of it.
A couple of the questions in the news conference after the decision were focused on the new president-elect in the United States, Donald Trump, and his threat quite early on to impose 25% tariffs on imports from Canada and Mexico, as well as an extra 10% on China, which would, push up prices for imported goods in the United States, let alone Mexico, who've threatened a response. Globally, if we see some sorts of trade wars develop, the EU, China, the United States, all essentially pushing up the prices of consumer goods and any imported prices, is there a risk of a sort of a global inflation shock, another one that comes out of nowhere?
Yeah, there is. And, to be quite honest, I don't know the answer, right? But I'm an economist, so I'm not allowed to say that. I have to make something up. There's two schools of thought. There's a school of thought that you get this tariff war happening, and China and others actually divert their goods away from the United States, and we might actually get cheaper goods coming through here, which might actually be deflationary. And then, of course, there's the other side of the argument that, that's tit for tat, and it sort of, causes quite a disruption that could be inflationary. So it's really, really hard to navigate, really hard to nut out, to be fair. And it just goes back to our earlier point. There's just so much uncertainty around Trump and Trump coming back in.
Yeah, and it's hard for financial markets to try to price in that uncertainty into, for example, the US 10-year Treasury bond yield, my favourite price in the world, which reflects how the world's most liquid financial markets view the future of inflation in the world's biggest economy. And because it is the world's biggest, with the reserve currency, with the most traded safe asset, US Treasuries, it flows through into a lot of the prices that we have in our economy. Not directly in the form of floating mortgage rates, but if you've got a 5-year mortgage rate or a 2 or 3 year mortgage rate, those bond yields in the United States do have an impact. And I wondered if the United States, with its quite loose fiscal policy, and we've seen some backing up of bond yields in recent weeks because of that, whether New Zealand and its mortgage rates, at least the longer-term mortgage rates, might actually, face some more collateral damage from a very loose fiscal policy in the United States.
Yeah, I'm really glad you said that the US Treasury 10-year yield is your favourite price, because it's mine too. There's not many of us out there, I don't think, but it's the first thing I look at every morning, right? And you are right, it probably is one of the most important prices globally, right? And it gives you a really good idea of how markets are trading and what people are thinking. And yes, that 10-year yield lifted quite a lot in the lead up to the election, because traders started taking bets that Trump would get in, and then with him coming in, that yield just kept going, and that reflects a few things. So when you think of a yield, particularly over 2 years, 10 years, you're thinking of some sort of growth, some sort of inflation, and something called term premium. And when you start thinking about more debt, more inflation, even more growth, you have to factor in that higher yield, and that's exactly what we saw. That's what transpired. And you correctly, you start with that price, and then you think, where's New Zealand's 10-year? Well, we're at a spread to that US price, right? And we get pushed up and down by that. So that 10-year yield, the change in New Zealand's 10-year yield is driven more by the US than it is actually New Zealand factors. And then you gain more traction as a central bank the shorter the rate that you deal with. So yeah, you're absolutely right. Key factor, something to watch. And yes, does that have an influence on that 3, 4, 5 year mortgage rates? Absolutely. And those rates have lifted.
Yeah, the Reserve Bank governor was asked about this in the conference, and he said that many borrowers were increasingly aware of the rise in interest rates overseas for the longer-term bond yields, and were therefore maybe less likely to just jump for the shortest possible fixed rate, because there's a risk that while you expect interest rates to fall, they may not fall as far or as fast as perhaps we might have been thinking earlier this year. Is that something that people who are fixing or floating, not that we're giving any specific individual financial advice to anyone, this is a very broad thing, everyone's situation is different, but, could the Trump effect mean that we see people fixing longer, perhaps a bit earlier than they otherwise might?
Yeah, potentially. I mean, what we thought was quite interesting was that people did listen and start preparing for rate cuts, which was great, because we were all hammering that message. But if it falls on deaf ears, you haven't had an influence. Whereas we were calling for cuts. People did shorten up their mortgage duration. Instead of fixing for 2 years, they fixed for 6 months or whatever. That's great, because now that these rate cuts are coming through, they're benefiting sooner than they would have been otherwise. The next part's a bit more difficult, trying to pick the bottom of interest rates, and I think that is a story for next year. But when you start feeling like you're getting close to that bottom, that's when people start to fix for longer term historically. So I do think that's a discussion we'll have next year.
We also talked in the press conference about the so-called neutral rate for interest rates, which is one of these magical things that you don't know what it is at the time. You only work out what it was after the fact.
Yes.
And it's quite hard to sort of even forecast, because it's one of those magical things. But it's important because central banks think about it a lot, and they think, as I suppose you would if you were driving a car or a plane, am I accelerating? Am I on the other side of neutral, or am I slowing down underneath neutral? And the Reserve Bank currently has an estimate of around about 3% for the neutral rate. Typically, when you think of a neutral, you think of the speed going up above neutral and then down below neutral and back up again like a sine curve. But in this case, the Reserve Bank is only forecasting that the official cash rate, projecting, taking a stab, that it would drop down towards the neutral rate, but not under it. Why do you think we might not see interest rates go under neutral?
Good point. So I guess you are always somewhat optimistic that you're not going to cause another slump, right? And in order to go below neutral, you're really at a point where things have gone, quite bad, quite horribly wrong, and you're needing to stimulate again. And that's when you go down to sort of 2% or below, something really, and you're trying to revive the economy. I think their forecasts and our forecasts are kind of aligned in that we think we are going to recover as the cash rate goes from really restrictive to less restrictive to something close to neutral, and that should be enough to guide us out. But yeah, within those realms of possibility, should global conditions deteriorate substantially and our conditions deteriorate, then yeah, they'll be stimulating hard. They'll be cutting, quite aggressively, but it's not something you can really forecast as your base case. Otherwise, you're admitting you've done something wrong right now.
Yeah, that's right. And just finally, for the interest rate geeks in the audience, you and me together, really, the Reserve Bank Governor also talked about the medium-term outlook for inflation and interest rates, and talked about the chances that quite low productivity, and the Reserve Bank lowered its productivity forecast in this set of forecasts, low productivity, potentially an aging population, potentially, geopolitical risks like tariffs from Trump, and the effects of climate change, keep seeing those insurance rates going up, that all of those things could, keep inflation higher than we might have normally expected in the longer run. Again, hard to forecast, but what do you think of those ideas that there are some structural inflationary forces at work here?
Yeah, look, I think the climate change one is definitely yes. As we have to invest, build back better and invest, so we're more immune or better prepared, I should say, for climate events. So that's very inflationary, very expensive, a lot of investment required. And then you think about some of the other issues around insurance and all that stuff coming through, council rates, all that stuff linked to climate change as being quite inflationary. So, just on that alone, I think, maybe it's a CPI basket that sort of strips out some of these climate-related costs, or it is a lift in your target band. Maybe it's something like the RBAs where you just tweak it a little higher to sort of 2 to 3 target, 2.5% midpoint, whatever. As you say, that there are other things, and the jury is out on the aging population bit, because as we age, we become more savers, and potentially that puts downward pressure on rates and growth. So that may work the other way, but then there are all these other issues that I think are problematic in New Zealand, and that we've got low productivity because we've underinvested for decades, because we haven't done what's required to make our economy harder, faster, better, that we may have to pay for at a later date with either higher inflation or the real desperate need to catch up on investment.
Jarrod, fantastic to talk to you again on one of our big 4 days of the year. It's like having 4 versions of the Olympics for us monetary policy, interest rate, inflation geeks. Great to chat again, and good luck for the summer and into next year. I suspect there's a few people with mortgages who have a bit more of a skip in their step today.
Absolutely, and thanks for having me back on, Bern. It's always good fun.
When the Facts Change was brought to you by the Spin-Off Podcast Network, together with Kiwibank. Visit kiwibank.co.nz to find out how Kiwibank are making Kiwi better off.
Does your brand have something important to say through meaningful messaging that reaches the right audience? At The Spin-Off, we work closely with our partners to create bespoke campaigns that bring value to both your brand and our audience. If you're interested in learning more about partnering with us, email Beck, that's BEC, @thespinoff.co.nz.
Kia ora e te iwi, Te Aihe Butler here, podcast manager at The Spin-Off. If you enjoy listening to our podcasts, consider supporting our mahi by signing up to become a Spin-Off member at thespinoff.co.nz/donate.
The Spin-Off Podcast Network.